Ladies and gentlemen, good day and welcome to the Q4 FY23 results conference call of Welspun Corp Limited, hosted by Emkay Global Financial Services. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions at the end of today's presentation. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhineet Anand from Emkay Global Financial Services. Thank you, and over to you, sir.
Thanks, Michelle, and good morning to all the participants. I'd first like to thank the management for giving us this opportunity to hold the call. And I will now hand over to Mr. Salil Bawa, Head, Group Investor Relations, Welspun Group. Over to you, Salil.
Thank you very much, Abhineet, and good morning to all of you. I welcome all of you to the Q4 FY23 earnings call of Welspun Corp. Present along with me today on this forum are Mr. Vipul Mathur, Managing Director and CEO, Mr. Percy Birdy, Chief Financial Officer of Welspun Corp Limited. I also have with me my colleague Gaurav Ajan, who leads IR for Welspun Corp. You must have received the results and investor presentation of the company, which are also available on the BSE and NSE and on the company's website. As usual, we will start the forum with some opening remarks by our leadership team. We will then open the floor for your questions. During the discussion, we may be making references to this presentation. Kindly do take a moment to review the safe harbor statement in our presentation. Should you have any queries that remain unanswered after this earnings call, please feel free to reach either of us. With that, let me hand over the call over to Mr. Vipul Mathur, Managing Director and CEO of Welspun Corp. Over to you, Mr. Mathur.
Thanks, Salil, and good morning to everyone. Welcome to our Q4 FY23 conference call. I greatly appreciate you all taking time out today morning to attend this call, and I hope all of you are doing well. As customary, I will first take you through the key highlights of our consolidated performance during the quarter and the year ended 31st March 2023. As Welspun Corp, we once again achieved a coveted 1 million ton global line pipe sales in FY23. This is the 8th time in the last 10 years, that we have breached this mark. This is only a clear reflection of our very stable and a consistent performance in our line pipe business. The revenue from operations stands at 9,758 crore rupees. It's a growth of almost more than 50% on Y-on-Y basis. EBITDA for this quarter is around 483 crore rupees, and for the FY23 stands at 805 crores. We have also completed the acquisition of Syntex BAPL and the specified assets of ABG Shipyard. We are fully in control of these two assets. On the sustainability side, we have been ranked in the top 7% in the steel industry in the DJSI Corporate Sustainability Index. On top of it, we also have a very strong order book of almost 1.1 million ton, a global order book of 1.1 million ton, valued pegged at 14,600 crore rupees. If I move to the quarter performance, for the quarter, the production and the sales volume in our line pipe business for our total operations, including Saudi, was 374,000 tons and 345,000 tons respectively. We achieved a sales volume of 200,000 tons in India. Out of US was close to 30,000 tons, and from Saudi operation close to 100,000 tons. Let me also give you some update and our assessment of the market outlook as we see the key drivers for each of our business. As you know, Welspun Corp is now a conglomerate, having interest in line pipes, in steels, in shipyards, in stainless steel. So it's a very diversified, and that's the reason we want to give you a very clear market, our assessment of the key market drivers for each of the business. First, coming to the line pipes. The line pipe business has seen a robust performance, sales volume of 345,000 tons in Q4 and almost more than 1 million tons in 1 year. the overall environment for the oil and gas capex is very favorable across the world. In the beginning of April, Saudi Arabia and the OPEC Plus oil producers announced oil output cuts of around 1.6 million barrels per day. The pledges bring the total volume of cuts by OPEC Plus to almost 3.6 million barrels per day, which is equivalent to 3.7% of global demand. OPEC Plus has been expected to stick to 2 million barrels per day cuts already placed in the year 2023. These cuts is clearly reflecting the stability in the oil market. If you see, the oil market is completely range bound between $70 to $90 per barrel at this point in time, and for the last considerable time. The IEA also said the world oil demand is set to grow by 2 million barrels in 2023 to a record of 101.9 million barrels, driven mostly by stronger consumption. Oil market balances are set to tighten in the second half of the 2023, with the potential for a substantial supply deficit to emerge. On one side being the production cut, on the other side the demand staying strong. I think so we are very confident, and we feel that this range bound oil, but the prices of the oil will stay range bound. On the gas prices, we have seen that there has been a little softening, but then the demand has been extremely high. As regards India, the target has been set to increase natural gas consumption from 6% to 15% in our energy mix by 2030. The vision of one national, one grid provides for all necessary infrastructure in this regard. The length of the gas pipeline network in 2014 was around 14,000 kilometers, which has been increased to 22,000 kilometers. In the next 4 or 5 years, the gas pipeline network in India is expected to reach 35,000 kilometers. India is the world's third largest consumer of crude oil and depends on imports to meet over 85% of its requirement. According to the International Energy Agency, India's oil demand could rise from 4.7 million barrels per day in 2021 to 6.7 million barrels by 2030 and 7.4 million barrels by 2040. The country currently has a refining capacity of 250 million tons, and there are plans to increase it around 450 million tons per annum over the next few years as India's oil demand is expected to rise. Energy scenario across the globe is also changing due to the geopolitics resulting in strong export demand. In the export market, we are in all what I said till now was for the domestic side of it. We see that the domestic demand is going to be strong. We are contemplating that the investment in the oil and gas infrastructure will continue to happen as it has been happening for the last 4 years. And we see for the next 4 to 5 years, this demand is bound to be there in the infrastructure space. On the export market, we are in active discussions for several other orders across the world. As you are aware, we recently announced the award of an export order to one of the countries in the Middle East. It is approximately 83,000 metric tons. These pipes will be supplied for offshore production and transportation of gas, which will accelerate and enhance LNG export infrastructure in one of the largest LNG producing and exporting country in the world. There also has been a revival in the water sector by the strong pent-up demand after subdued growth over the past 2 or 3 years. Our wide geographical presence within India, which means our presence in West, Central and Southern India, along with a very robust supply chain, will help us to cater to this emerging demand. Coming to US, which is also one of the mainstay in our earnings, we are seeing that a record LNG exports from US has helped soften the blow to Europe from sharply lower Russian pipeline natural gas supplies in 2022, and will remain a vital energy source for the continent even in 2023. Rising global demand for the natural gas is a growth opportunity for US LNG producers, but delivering on this opportunity will depend on timely construction of natural gas line pipeline infrastructure to support new LNG gas supplies. At this point in time, our spiral plant is fully booked till December of 2023. The current business environment is very favorable. We are seeing a lot of tailwinds, and we are in active discussions to book new orders beyond December 2023, and we are very optimistic around the same. Coming to Saudi Arabia, I am sure you all are noticing the exponential growth which is happening in Saudi Arabia. Today, Saudi Arabia has the highest annual growth rate among the world's 20 biggest economies in 2022. And according to the latest data of OECD, and have plans for the huge growth in infrastructure projects. Saudi Arabia is expanding its maximum sustainable oil production capacity to 13 million barrels per day by 2027. In this regard, Saudi Aramco is greatly expanding the capacities of its offshore oil fields, which is a crucial element of its strategy to boost the country's oil production. Its own capital expenditure in this year is expected to be between $45 billion to $55 billion, with capex increasing throughout the decade for the next 10 years. In their recent quarter results, Saudi Aramco reaffirmed the intention to move forward with their capacity expansion program. The long-term outlook remains unchanged as they believe oil and gas will remain critical components of the global energy mix for foreseeable future. Saudi Arabia is also expanding its gas production capacity and aims to achieve a 50% growth in their gas production by 2030. So both oil production and network, and gas production network continues to be a key focus attention in Saudi Arabia. And as you are aware that recently our associate company in Saudi has signed a contract with Saudi Aramco for supply of large diameter steel pipes, which is valued at almost 4,000 crore rupees. This is one of the single largest order our Saudi company has won from Saudi Aramco, and it represents a major share of the first package of Master Gas Phase 3 program. With this order in place, our plant is booked for the next 1 year, if not more. We are also seeing a robust demand in the water sector, with multiple lines to carry desalinated water to be awarded shortly, out of which we are in any case poised to win some more orders in due course of time. The water company, SWCC, is investing in increasing its capacity to desalinate, transport, and store water to meet increasing demand and further enhance water supply security. Given the vast geography of Saudi Arabia, the transportation of desalinated water to its demand center is of very key importance. Today around 13.9 million cubic meters per day can be transported across the country. This capacity is currently being increased by an additional 56% and a further expansion by 44% in 2030, which means there will be almost 100% capacity expansion between now and 2030. This was my outlook on the pipe side of our business, the pipe vertical. Now I would like to draw your attention to the steel side of our business. We have seen, as you are aware, that we have commissioned our blast furnace and our DIP plant. We have seen a steady ramp up in our hot metal production, almost achieving our target production levels. Whatever we have targeted for, we have almost reached that production levels. All ancillary facilities around our blast furnace like sinter, coke oven, PCI and oxygen plants have also reached their targeted production levels and aptly supporting the hot metal production. There has been a steady ramp up in the volumes across the full production range and on expected lines in our DI pipe business as well. The quality and the timely deliveries are well accepted and highly appreciated by the customers. To make provision of potable water supply to every rural and urban household of the country by 2024, Government of India in partnership with states is implementing the Jal Jeevan Mission. The impetus of water supply infrastructure is continuing, with the JJM receiving an allocation of almost 70,000 crore rupees in the Union Budget of 2023, significantly higher than 50,000 crore rupees what was allocated in the last fiscal year. For the DI, as we are aware, it is a business of all about approvals and accreditations. I am very pleased to say that we have already received all necessary approvals and accreditations in the state of Gujarat, Rajasthan, Maharashtra, Madhya Pradesh, Chhattisgarh, Uttar Pradesh and Punjab, which are our top priorities areas in any case. We are seeing a consistent demand from all the states coming up and have already supplied and have a track record of supplying pipes in most of these states now. It is very clearly reflected in our performance. We have a strong order book of almost 140,000 tons, valued at more than 1100 crore rupees, and we are aiming that this year we should be producing, selling anything between 175 to 200,000 tons of DI pipes, which will almost be 45 to 50% of our capacity utilization. This is a ramp up. We are currently in a ramp up journey. We are in the first 2 quarters, and as you would have seen, our quarter-on-quarter ramp up has been absolutely on the expected line. I think so in the next 3 to 4 quarters time, we will be there in terms of delivering the guidance what we are giving in terms of execution. As regards TMT bars, our newly commissioned state-of-the-art plant has started ramping up dispatches. The key target market is the state of Gujarat, where the estimated annual demand is close to 3 million tons. Within Gujarat, we have seen a healthy demand in the area of Kutch, where our plant is located. This will be one of the key priority market for us due to our strong presence. We intend to be a strong player in the B2C segment, and our brand Welspun Shield has been extremely well accepted in the Gujarat market. We are now considered as a tier 1 supplier within the producers of Gujarat on the basis of quality and service. We have also created a unique and industry-first digital platform for distributors, dealers, retailers, and influencers. This is not only creating a positive socio-economic effect, but also helping us with a deeper penetration in the market to achieve our B2C goals. Our product has successfully reached to 24 districts and 69 talukas across Gujarat through 120 dealers and 6 distributors. This is bound to grow in subsequent quarters. Our target is to reach to every district and every taluka of Gujarat by the end of this financial year. I now like to draw your attention to our company, the Welspun Specialty Steels, which is our stainless steel part of the company. The stainless steel business has seen a surge in demand in sectors like defense, petrochemicals, nuclear, reactors, and process industries. There is a strong potential in Europe and North America. Further, the anti-dumping duties on stainless steel pipes and tubes for cheap exports from China have come into effect, which has significantly improved the business prospects for Indian mills like us. In the SS bar business, the company has started offering expanded product range from 50 to 200 millimeter to 25 to 350 millimeter diameter. We are also working in further expanding this range. This range is a very unique range which we possess and puts us into a very coveted position. Further, the Make in India initiatives by the Government of India is providing further impetus to this business. We have seen a strong turnaround in the performance, both operational and financials, and I am pleased to report that WSSL is an EBITDA positive company in this financial year. The current order books of this company stands at almost 3,500 metric ton, which comprises both of bars as well as pipes, and is pegged at 155 crore rupees. The company has also received all certifications with respect to its blooms and ingots, bars, and seamless pipes and tubes. These certifications will cover the entire spectrum of their product offering into the market. This is an extremely favorable development for an integrated players like WSSL. I am also very glad to inform that the company has booked its first order for a very high value nickel alloy grade 6625. As you know, this is a boutique business, and as you move up in the value chain, what are the value added products you are servicing? And 6625 is considered to be one of the most stringent and difficult and cash accretive value grade of the product. And our company has been able to book the very first order in this particular grade. The company has also booked and supplied pipes and tube order in other high value grades like alloy 800H, 8825 and Monil 500, etc. The company expects its improved performance to sustain on the back of several new customer approvals, accreditations, development of new products, and penetrating into new markets. Let me also now draw your kind attention to our recent acquisitions, which is about Syntex and our shipyard, which is erstwhile ABG. So let me just throw a little update on that as well. As I said, we have taken full control of the assets at Syntex BAPL. Syntex continues to be a national brand with premium positioning. It is best known brand of water storage tanks in India, and the brand connect is synonymous with water tanks. When you talk water tank, it is Syntex. The company enjoys a very robust distribution network of 900 distributors and 13,000 retailers. They stay intact and are going to act as catalysts for our growth. The current market share of Syntex in water tanks is estimated to be about 9%. Every effort is now being made to increase this market share in FY24 by re-energizing the distribution network, the product and brand positioning, bringing in supply chain efficiencies, re-energizing our dealer and distribution network. We are extremely excited about its prospects in the subsequent quarters and years to come. Navyan Shipyard, which is the erstwhile ABG Shipyard. As you are aware, we took the full control of that asset, and as I reported earlier, we are currently in the process of liquidating the scrap which is there. So we are moving steadily to monetize the scrap, which should be mostly completed by the end of this financial year. This will result in a steady cash flow. During this period, we will be incurring a very minimal fixed cost. Further, I want to make it clear that we are not exploring any capital-intensive options like shipbuilding. Instead, we are exploring options with respect to ship repairs, ship recycling. In this regard, we are in discussions with various established companies in the world and doing our internal and doing a comprehensive assessment, which I expect to complete in next 2 quarters' time. The endeavor will be to come up with a low capex, non-cyclical business, high return and value accretive proposition, basis which we will formulate our business plan for the next financial year. So what we are trying to do, 3 things. Number 1, we are trying to liquidate the scrap so that it gives a steady cash flow. Number 1, we have restricted our outflow. We are keeping a very strong check on the fixed cost outflow. We are not doing any capex at all, and we are working in terms of finding out a value proposition and for which an exercise is being done, and we will be done in next 2 quarters' time. I also want to draw to the ESG initiatives which the company stands by. As you are aware, the company lays a strong emphasis on sustainability and governance and has been ranked in the top 7% in the steel industry. The DJSI score, which reflects this, which recognizes this initiative, has now significantly improved from 41 to 57 in FY 2022. As regards on the balance sheet side of it, we have seen a sharp reduction in our net debt by almost 700 crore rupees in the quarter from our debt net debt as on March 23, and it stands at around 1140 crore rupees. Further, it will be our endeavor to utilize cash and utilize cash in further reduction of gross debt. At the same time, our focus will also be to utilize the free cash flow what we are going to generate over 23-24 to further reduce our net debt. We are confident to make a significant reduction in the same as well. Looking at the various companies which are now in the Welspun fold, right? I think so it is fair on the market side to expect that what sort of a guidance we are putting in place. Typically, when we were a standalone pipe company, we were always hesitant in doing that. But I think so in order to bring confidence and give clarity to the market, we have worked out and we are giving you a broad guidance for the FY 2024. We are expecting our top line to be close to 15,000 crore rupees, which will be a growth of almost 50% from the current top line. We are also hopeful of achieving an EBITDA of close to 1,500 crore rupees, which will almost be a growth of 90 to 100% than our current levels. Our strong focus is on return on capital employed, and we are optimistic of generating a return of 16% plus in this FY 2023. We are also very focused that this year we are not going to do any capex except for our maintenance capex. We will turn our strong focus in the performance of Syntex, DI Pipes, and WSSL. These are all the 3 new companies which has come into our fold, and we will lay our maximum emphasis and time allocation in respect of growing these businesses. Having said that, the focus on the pipe company will always be there, and it is in any case a very steady state and a consistent EBITDA producing given company. Further, we will work on sustainability and to improve our DJSI scores from current 57 to at least 60 plus. If I summarize of all what I have just communicated, first we achieved a 1 million ton sales in the line pipe, 8th time in the 10th year, 8th time in the last 10 years. We have a strong order book of almost 1.1 million tons, valued at 14,600 crore rupees. We have provided a guidance for FY24, which shows improvement on all key metrics, including turnover, EBITDA, ROCE, and also on the net debt side of it. We are ranked as on the top 7% on the steel industry on the DJSI's Corporate Sustainability Index, and we will continue to improve our scores on that. We have completed our acquisition of Syntex BAPL and ABG Shipyard. There will be no capex other than the maintenance capex in this current year. The investments made in all these new businesses will start accruing. Will start accruing, and we'll see the benefit over the next quarters in the subsequent years. The demand outlook for all these new businesses is extremely healthy, but works need to be done to scale them up from operations and cost point of view. We are firmly working towards Har Ghar Se Har Dil Tak Welspun by expanding channels within Syntex and TMT business. On the Syntex, as I said, we are working in terms of improvising the supply chain, operations, brand, sales channels, marketing, dealer network. They are all being worked upon, reinvigorated. The brand pull, it is a national iconic brand. The brand pull is good. We are now almost 60 days, close to 60 days into this acquisition of business, and the first impression what we are getting is very, very favorable. The early signals are extremely positive, and we are enthusiastic about the prospect of this particular business. With this, I thank everyone for attending this call, and we're happy to take any questions if you have any. I open the floor for the questions, please. Thank you very much.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may press star and 1 to ask a question. We have the first question from the line of Miraj from Arihant Capital. Please go ahead.
Good morning, sir. This is Abhishek Jain from Arihant Capital. Congratulations on good and improved set of numbers. So just want to understand what will be the sustainable inventory going forward, because I can understand because of entering into new business, and so how much inventory we are going to see on a sustainable basis, how much inventory we are going to keep it?
Good morning, Abhishek. I think so. It's a very interesting question you have asked. We have seen an inventory increase in comparison to the last financial year, but you have to understand this inventory increase is because the growth in all the businesses. The major inventory increase is in our US business, where we are executing a large order, and the entire inventory has been procured and sitting with us, and it is already a paid up inventory in any case. But we have also started execution of that order, and we will see now a gradual reduction coming up on the inventory side of it in the US. Further, we have inventories in ABG, which is almost valued at 500 crore rupees. As I said, that the scrap sale process is already on, and the moment as the process will continue, you will see a reduction in the inventory coming there. In WML, WDI, of course, the nature of the business is that you have to maintain an inventory level of iron ores and fluxes and coal and all that stuff. So it's a fairly normal inventory level of almost 500 crore rupees we maintain, and it is pretty regular in nature. On the WSSL side, we have inventory of close to 200 odd crore rupees, but this business also has an order book of almost close to 4 months' time, and that inventory levels need to be maintained. On the pipe side of it, we have an inventory of close to 1,000 odd crore rupees, I think, which was on account of the export orders what we have, and as the export orders are now getting executed, so this will also start to go down. So we have to understand that the size of the balance sheet, the size of the operations have almost prepared. So I think so that is where you will see that there is an inventory which is there has been a high inventory, but this is all against order and all and as they start getting executed over quarter-on-quarter basis, you will see a gradual reduction happening there.
Thank you, sir. Sir, my second question is, as per our understanding, we can generate a healthy amount of cash flow in next 3 years. So can we assume in next 3 years we can achieve at least a net debt-free kind of status, sir?
We can expect what? Sorry? Net
debt-free. Net debt-free. What's your debt repayment cycle?
Abhishek, you have been following this company for a long time, right? As Arihant Capital, we know that you have been following this company. Our focus always has been to, leverage our balance sheets very, very correctly. This is not the very first time that we will be doing this. Our strong focus remains on bringing our net debt to absolutely minimalistic level. We are absolutely on that track. I think so all the businesses, all the new old businesses, which is the pipe business, and the new businesses, which are all shaping up and growing, I think so you're right, will generate sufficient cash flow, and our endeavor would first be to reduce our the gross debt at the company level.
Sir, I have Miraj. We have one more question, sir.
Just one question. Wanted to understand if you could give highlights on the Saudi order that you've spoken of, which is the 4,000 crores. If you could give us what the volumes would be for that, and how many more orders can we expect in the phase 3, as since this is the first order in phase 3?
So right now, coming to the Saudi part of it, this order, as you know, is from Saudi Aramco. It is for a project called Master Gas Phase 3, right? I think so. In this Phase 3, order will be happening in 2 parts. One in this financial year and the other in the next financial year.
This is the operator. Can you hear me, Mr. David Smith? May I please know your company name? This is the operator.
Expecting some orders coming up from the water sector, and we will be absolutely looking those orders very, very closely, so that we have a business continuity even after 4 quarters. So I am very sure that we will be able to do that. Then it will be followed by Master Gas Phase 3, second phase. So I think so there is a clear business continuity case in Saudi business for at least the next 2 or 3 years' time.
Thank you, sir. I have a few more questions. I'll be in queue, sir. Thank you for again, and congratulations on good setup number. All the best, sir.
Thank you. Thank you, Michelle.
Thank you. The next question is from the line of Nirav Shah from GC Investments. Please go ahead.
Good morning, sir, and congratulations on very strong profitability during the quarter as well as the deleveraging. So a few questions. Firstly, we are seeing that while the EBITDA has increased, our US volumes haven't, they've remained almost flat on a sequential basis. So a large part of the increase is coming from India line pipe operations, as also DI is in the ramp-up phase. So if you can just give a broad breakup of the EBITDA during the quarter, that would be really good. And if the EBITDA is led by India line pipe operations, was it because of some one of marquee high margin orders, or it's a sustainable number? Yeah, thank you. That's the first question.
So Nirav, coming for your first question, US operations are, US mill is under full production mode at this point in time. Of course, in this particular quarter, the dispatches were slightly on the lower side, but that they were as planned and as designed. I think so from this quarter onward, you will see the major execution of the order what we have in hand will start, and that they will start getting reflected into the quarterly numbers. As you know, we already have an order book of close to 400,000 tons in the US business at this point in time, and we have almost a firm visibility of this firm business in hand till the December of 2023. in this particular quarter, I think so the India operations, the major chunk of the EBITDA came from the India operations, because the product mix in India was very profitable. They had in their kitty some very remunerative export orders which got executed. And moving forward, I think so the blend of the orders they are building up in their own in the Indian kitty is also looking very favorable to me, and I think so we will see the benefit of that coming in the subsequent quarters as well. But as you know, Neeraj, just to also want to add a word of caution that it is also about the product mix on a quarter-on-quarter basis.
And that changes depending on the execution.
That changes the blend a little bit, yeah. Got
it, sir. Second question, I mean, you've given a broad indication of why the inventory has moved. But just coming to the US operations, of the 5,000 odd crore of inventory, 5,700 crores, how much would be sitting in US, and also the payables have increased because of, I am assuming because of US operations as well. So on a net working capital basis, will we see a reduction in the working capital at US?
So to your first question, I think so out of this 5,700, the large chunk, almost close to 3,400, 3,500 crore rupees is sitting in US only. And as I said, it is an inventory against an order. One, it is already a paid up inventory because the payment terms are favorable there where you are paid upon buying the inventory. And more importantly, as we are into as the dispatches will start, you will see in the subsequent quarters this inventory position going down.
Okay. And lastly, before I come back on the queue, so what's the scrap inventory in terms of tonnage that we are holding as of March at ABG?
As I said earlier, I think that the total overall scrap was close to 150,000 tons in ABG. Yeah. That's what we have told earlier as well, and that is what we are in the process of liquidating. And it is in a very steady manner. It is getting liquidated, but it will take almost at least three more quarters, if not 4, before everything will stand liquidated. So it will, so it will give us a sort of a steady cash flow for the next 2-3 quarters. And more importantly, Neeraj, we have to understand that we have kept, as I said earlier in the earlier part of my call, is that we are keeping our fixed cost at a very, very low level. At this point in time, we are not pumping any money whatsoever in ABG, so that just to give you the comfort.
Yeah. And we mentioned that this year will be only maintenance capex. So on the entire operations with the addition of new businesses, what will that number be?
Yeah, typically when we used to do a maintenance capex when we only had a pipe business, it used to be in the vicinity of close to like say 70 to 100 odd crore rupees. I think that this time it should be close to 250, 300 crore rupees, looking at all the businesses put together.
Got it, sir. Got it. Great. Thanks, sir, and all the best.
Thank you, Neerav.
Thank you. The next question is from the line of Vikas Singh from Phillip Capital. Please go ahead.
Good morning, sir, and congratulations on a very good set of numbers. Sir, I want to understand our bid book which have increased basically 46% on a quarter-on-quarter basis. So what are the new geographies where you are seeing the new green shoots and some insight into the European market, because after war it was touted as a very good market, but nothing has come from there as of yet. So if you could just give us some insight into that.
Because the growth in the bid book is largely driven from 3 regions. Number 1, Southeast Asia. We are seeing an exponential demand in the Southeast Asian market. 1. 2 is the Middle East market. We are seeing a very buoyant Middle East market, and at least 2 economies in Middle East, which is Saudi and Qatar, are absolutely firing up. So we are seeing a very pent-up demand from these 2 economies. And of course, third is also coming from our US, because we are seeing a lot of, there's a huge traction in the US market as well in the oil and gas sector. So this bid book increase of 46% is a reflection of the pent-up demand in these 3 geographies.
Understood, sir. And sir, my second question basically pertains to, sir, what is the out of 1.1 million of total order book, what is the outstanding Indian order in terms of tonnage?
Yeah. So right now, as I said, we have almost close to almost like 400,000 tons of an order book in our US entity. We have almost close to 250,000 tons of an order book in our India entity, and we have close to 475,000 tons of an order book in our Saudi entity. So that is the breakup of almost 1.1 million.
Okay, sir. Sir, coming to Saudi operation, that is the most strong order book geography right now. So just wanted to understand the incremental cash flow which would be coming from executing those orders basically. What would be the utilization of the same?
So first I would say that Saudi order book and the US order book both are very strong. Saudi is at 475 and US is equally 400, almost close to 400,000 tons. Both of them have a very strong order book. And thirdly, coming to the Indian order book, at 250, we are still in very active discussions for some new orders, and this will also significantly grow up in subsequent quarters. So that's one. Coming to the cash flow, as you know, we are a 35% stakeholder in our Saudi entity, and still the largest shareholder. Whatever the earnings which will there in the proportionate, they will flow back as the dividends to us, and that is what we are estimating to come in the FY 2023.
So effectively, that money would come in the form of dividend to us. Understood, sir. So just one last question. In terms of basically overall visibility side, you have talked us in the US that it's very good, etc. But then next year, usually US would have an election, and we have seen the election year usually would be a little bit weaker. So have you already started getting any signs, because already in the middle of the 2023? So just some thought process on that, whether it would be the similar pattern or this time it could be different because of the energy needs requirement.
Because of, we are seeing a fundamental shift in the US situation at this point in time. It is like, oil and gas, I think, has been clearly identified as a key priority area, irrespective of the political dispensation. Be it the Republicans or be it the Democrats, they have all clearly understood that oil and gas is going to be their major mainstay. So, earlier, as it used to make a significant impact during the election year, we are not anticipating any such thing in this, at least in the coming years. And that is that is also bringing up confidence with all the E&P and the midstream producers out there, because it is not agnostic whichever political dispensation is in place. So that is one of the reasons we are seeing a steady inflow of inquiries coming up from US. So to your question that the election year, the next year election, is it going to slow down the whole process? We feel that it won't make much of an impact.
Understood, sir. And sir, just on your views on the European demand, when we expect that region to start picking up on the pipelines order?
See, European demand will majorly now come in terms of the new energy businesses. There will be quite a few projects which will come up for carbon capture and hydrogen. And as you know that we are, as Welspun, we are aggressively working in terms of, or rather we are ahead in the curve in terms of our new energy businesses. So we will see that demands coming up in next 2 or 3 years' time on the new energy. As regards to oil and gas demand, I think so. It will be a muted demand because all the Russian gas is now completely supplemented by the US supplies, and that is why we are seeing that huge traction of creating a gas pipeline infrastructure in US, so that they can pump in more and more gas and export more and more to the world.
Understood, sir. Thank you for answering my question, and all the best for future.
Thank you, Vikas.
Thank you. A reminder to all the participants, anyone who wishes to ask a question may press star and 1 now. The next question is from the line of Achal Bagaria, an individual investor. Please go ahead.
Hello.
Yes, ma'am, please proceed.
Am I audible? Yeah. Good. Congratulations, sir, for a good set of numbers. Sir, can you actually, this question was already asked. I just want to get a more insight on this. The EBITDA proportion segment-wise, if you could throw some light on that.
I think so. Let's stay to the consolidated EBITDA, and I think so. In our one-on-one interaction, we can have a little more detailed breakup around that. But for this call, let's keep it on a average EBITDA, please.
Okay. And sir, can you provide some insights on what are our raw material sourcing strategies, etc. currently?
Raw materials, yeah, sure. As you know, that on the line pipe business side of it, we are one of the largest line pipe producers in the world. We have a very robust supply chain and sourcing strategy in place. We are one of the top 3 players in the line pipes globally at this point in time, which means we play in an absolute niche segment of the line pipes, where where approvals and accreditations are extremely difficult. There are just one or two players in that particular segment in which we operate, and that also demands that our supply chain correspondingly has to be extremely robust. So, which is we have almost a sort of a relationship with just about every steel mill in the world, and we have done extensive business with them. So on the pipe side of it, our supply chain raw material sourcing strategy has been extremely robust, and that has been one of the key factors for our success in the past years. On the coming on the other side of the business, which is the steel side of the business, it is the sourcing of iron ore or sourcing of the coal. These are commodities, and we are now a large buyer of these commodities. We are now an international buyer in these commodities. There are absolutely established players in this particular field. These all commodities are index-based commodities. So we have also now we are completely plugged into those, and we have now established a very, very efficient and a robust supply chain system about our iron ore and coal as well. On the scrap side of it, scrap is again a commodity. We are again buying scrap. That is the third raw material which we buy, or the fourth raw material which we buy. And for that also we have established sources from which we are sourcing the scrap. So on the raw material side of it, I think so. We have laid a lot of emphasis. We have completely streamlined the process, and we have an absolute robust supply chain system now in place.
And so just one last question, like what is the market outlook pertaining to the steel side of the business, like the WML, WDI business, etc.? What is the market outlook for the future that we are looking upon?
Yeah, as I said earlier in my call, the business looks very promising. For what it matters to us is the DI pipe business, and as you see, the Jal Jeevan mission is going full go at this point in time. There is a huge pull in the huge requirements across pan-India in this particular segment. I think so. We are seeing a sustained growth for our next 5 to 7 years time, and I think so. There is a great demand which is going to be there. It is we will have to take our own share out of that particular demand, and we are very confident around that.
Okay, and sir, anything about WML on the pig iron side of the business?
Pig iron is not a product which we want to sell. Our whole purpose of having WML is to supplement the DIP. Our focus is to ramp up our DIP and convert entire hot metal into DIP, right? But it is a process. It is a journey. It takes its own time. And you see on a quarter-on-quarter basis what significant improvements have been made. And I am sure that in subsequent quarters also, we will be absolutely ramping up to our fullest potentials, right? So as our DIP business will continue to ramp up, our pig iron business, which is, it will continue to go down. We are not focused about pig iron. We are focused about DIP.
Okay, sir. Thank you so much, sir.
Thank you.
Thank you. The next question is from the line of Abhishek Ghosh from DSP Mutual Fund. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. Am I audible? Hello?
Yeah, Abhishek. Good morning.
So thanks for the opportunity. Good morning. Just few questions. I don't know if maybe Percy can come here to just reconcile. I'm just looking at the cash flow statement, and if I see, from the September balance sheet, you have reduced as far as the net debt is concerned, but there is a meaningful increase in the net working capital, while you also have generated some operating cash flow, but the entire increase in net working capital does not get offset by the own cash generation, because the increase in inventories is far higher. So if you can just help me reconcile that how has the net debt come down? Is it because of consolidation of Syntex assets, or what is it? If you can just help me understand that.
Yeah, Abhishek, this is Percy here. So net debt has come down indeed from, if you look at from the December quarter, which was about 1,800 crores to now about 1,100 in March 23. And this is, of course, thanks to the strong EBITDA numbers also. So we had 483 crores of EBITDA for this current quarter. And there has been some working capital unlocking also that has happened. So some of the export orders from India, which have started getting executed. So there also we have had some unlocking, and this unlocking will happen in the next fiscal year as well as we go forward. So I think it's a mix of various things. Syntex acquisition also has been completed, you are right. And that has also turned out in a favorable way than what we had anticipated 1 year ago. So I think it's a mix of all these things, EBITDA, unlocking of working capitals, and the acquisitions getting completed. All these have resulted in reduction in our net debt. It's a substantial reduction, almost 700 crores in one quarter. So I think it's a very good number that we have demonstrated.
So just one clarification, the inventory levels in December quarter were already at similar levels from that of March?
Yes, December was very similar to March, you are right. If you compare with March 22 versus March 23, then yes, you will see there's a substantial increase. But that's of course various reasons we know. US was hardly anything in March 22, and most of the revival in US has happened in this last 3-4 quarters. So that's the reason.
Okay. Okay. And just in terms of how much of consolidation of cash has happened because of Syntex coming into the system?
So Syntex, the company, they have cash on the balance sheet. Some of that cash, of course, will get utilized because the CIRP balances will get paid out. So that will come down. But otherwise, they have sufficient cash on the balance sheet to carry out their operations, business, their marketing, their brand spend, whatever is their some balancing equipment that they need to arrange. So I think they have a very comfortable position as of now.
Okay. And just in terms of the overall guidance that you have given us about 15,000 crores of top line on FY24, and if you look at the current net working capital, you're broadly at about 4,200 crores. So just to get an understanding, for that 15,000 crores of top line, what will be the net working capital requirement?
So I think there is substantial growth, 50% growth in the top line that we have guided from 10,000 to 15,000, and you're right that there will be some working capital also that will be required to fund this growth. But we have seen some of the numbers like inventory numbers as of March 23 are also at a reasonably high level, and we will also see some unlocking of working capital happening. So I think on the whole it will balance out. Some of the old inventory will get unlocked, and depending on how we get new orders and how we are able to reinforce our order book, we might have to get in some more working capital infused as well. On the whole, I don't think there's going to be a very major increase or decrease. We should be able to deliver decent sized free cash flows. Okay.
Okay. And just one more thing on the overall domestic pipe business. There's been a sharp increase in profitability. If one can help, going forward as there's expectation of large amount of, water orders coming through, because also you have commissioned the new plant in Bhopal and other things. And typically water projects are a relatively lower margin business. So how should one, look at the margin profile as far as the domestic business is concerned?
I think it will, the domestic market, the domestic business is a blend of export and domestic, right? And this blend also includes execution in the oil and gas, execution in water, and third is the export. So it is a blend of these three things. So this blend keeps on changing. It's a project business at the end of the day. This blend keeps on changing on a quarter-on-quarter basis. In the last quarter, in this quarter, fourth quarter, it was extremely favorable. Moving forward on a year-on-year basis, I think so. It evens out. But on a quarter-on-quarter basis, it changes. So it's very difficult to say that is the performance going to get repeated in the next similar performance going to get repeated in the next quarter? Very difficult to answer because it is all dependent on the blend. I think any project company to that extent will have a challenge like that, and probably rather than looking at quarter-on-quarter, let's look on a year-on-year basis, please.
Exactly. So on an annual basis, your product mix will largely, whatever margins you've done, one should look at it from that perspective.
Correct.
Okay. Okay, sir. And just one last thing on the DI pipe perspective, you have seen a very good, inflow over there. What's the status in terms of stabilization of the unit? You've also broken in even as far as EBITDA is concerned, but any just current update in terms of how are the ramping up of the new plant is happening?
No, it's absolutely on track. It is absolutely on the expected line. I think so. We are very focused on the quality and serviceability apart from production. I think so. We are bucketing it into 3 zones, and all the 3 buckets, which is production, quality, and serviceability, I think so, are ramping up completely on the expected line. It's a journey. It's not, it's not going to happen overnight. We will, to reach to our fullest potential, we would still need a couple of more quarters, but it is absolutely on the expected line. Rather, much better than what we had expected.
Okay, great, sir. Thank you so much for answering my question, and wish you all the best. Thank you so much.
Thank you, Vijay.
Thank you. The next question is from the line of Ankur Agrawal from RC Wealth Solutions Private Limited. Please go ahead.
Congratulations, sir, for a good set of numbers. My question is regarding your target for 15,000 crore top line and 1,500 crore EBITDA. And in March quarter, you have did 4,000 crore and 12% EBITDA. So that means your margin will reduce in coming year compared to the March quarter?
Ankur, good morning. I think so. This is a broad guidance what we are giving at this point in time. It is just it's a reflection of the intent of the management. It is, do not read too much into that it will go down or go up. I think so. It is, at the end of the day, it will be a quarter-on-quarter performance and the financial year performance which will matter to us. But in terms of giving a guideline that how are we seeing with what direction the business is going to move, it is only a reflection of that. So I think so. Let's read to that extent only at this point in time. We are hoping that it is our internal target to deliver better than this. In any case, that is what our continuous endeavor would be, and we are very hopeful around that because all the businesses, the pipe businesses or the steel, the DIP businesses or our WSSL business, and our Syntex business, all the four businesses, as you see, are seeing a huge tailwind at this point in time, and to the extent we will be able to leverage it, these numbers will only improve from here. So I think so. Let's leave it at the guidance level at this point in time, and let's evaluate on a, let's say, half-yearly and a yearly basis, please.
Okay. How much capacity utilization at present in pipe business?
The capacity utilizations would be close to, our US capacity utilization will be almost close to 80-85%, or let's say 100%, because they have a confirmed order book for everything for our spiral mill. In our Saudi business, our capacity utilization is 100%. In our India business, our capacity utilization, average capacity utilization, because we have longitudinal mills, we have spiral mills, we have ERW mills. So I will say that our average capacity utilization will be close to 50 to 60%.
That means the top line can add more if capacity.
Sorry to interrupt. Mr. Agrawal, I would request you to kindly rejoin the queue. There are many other participants who are waiting for their turn.
Okay.
Thank you, sir. We have the next question from the line of Himesh Shah, an individual investor. Please go ahead. Mr. Shah, I have unmuted your line. Kindly proceed with your question. Yes.
Yeah. Am I audible?
Yes, you are.
Yeah. So when you give the guidance of 1,500 crores broad EBITDA, does it take into account just the operation?
There is an echo on your line, and there is a lot of background disturbance as well.
Is it better now?
Yes, sir. Please proceed.
Yeah. So when you give the guidance of this 1,500 crores of EBITDA, does it include the what you expect to receive from the scrap of ABG shipyard and your Saudi operations both?
No, this is excluding Saudi, number one. And of course, this is including the margins coming out of the scrap sales, yes.
Okay. And I just want to, understand, from the, broad perspective of, over the next 2-3 years, what will be your cash utilization look like? Because if you're generating around 1,000 crores of, free cash flows every year, what will be the priority areas?
See, we have always followed a very prudent capital allocation policy, right? We have, our focus has been very clear that number one, we have to invest in our growth if we have cash. Number two, we have to create reserves, and number three, we have to reward our shareholders. I think so. We are, these are our three pillars on which we always have utilized, and of course, deleverage our balance sheets and all that stuff. So this is the broad framework under which we have always worked, and we will continue to work in that particular framework. For us, all these four pillars are equally important.
Okay, and one last question. Now that you have many businesses under one umbrella, are you looking at any demerger in the medium term, let's say in the next 3 to 5 years, of any of the businesses?
We are, at this point in time, we are only focused on growth. These are all new businesses, all startups, and with huge potential. We are, at this point in time, our fullest energy is dedicated in terms of growing these businesses. We are not exploring any other options at this point in time.
Okay, and how much of your sales on the DI side will be will be from the group company, Welspun Enterprises?
Negligible, because I don't, it could be very negligible. I don't think so that they are so active into this water distribution network. I think so they are more on the infrastructure side of it, roads and buildings and highways, and I don't so they are doing something on the water, but I think so from a sale perspective it will be very negligible. But anyway, whatever it will be completely on a arm's length basis.
Okay. Thank you so much, sir, and all the best. Good set of numbers.
Thank you, Hamish.
Thank you. The next question is from the line of Saket Kapoor from Kapoor Company. Please go ahead.
Yeah, namaskar, sir, and thank you for the opportunity. Sir, coming again to the DI pipe of the story, sorry, I missed your utilization numbers and your order booking for the segment. What are the quantities that we are going to execute for this year?
Saket, you're talking about DI, right?
Yes, sir. DI pipe.
As I said, we have an order book at this point in time of close to 140,000 tons in the DI business, and this is by design. And I think so there is enormous potential to even increase this order book, but we are calibrating it with respect to our executional capability. As I said, we are working on 3 parameters. One is productivity, other is quality, and third is serviceability. These are the 3 key fundamentals on which we are working on it, and we think that this order book reflects is a very healthy order book at this point in time. 1. 2, to increase this order book is going to be extremely easy. We can always do that, and at an appropriate time we will again enter the market and increase it once we are, once our, the ramp up which is happening at the right pace, we are able to accomplish our targets around that.
And sir, our capacity for the DI pipe is what is the number?
400,000 tons.
400,000 tons. Correct, sir. And sir, with the lower coal and iron ore prices currently, do you think that there is a strong tailwind in terms of this DIP segment, and wherein I think so the realizations have also moved up? So if you could, hence the EBITDA per ton from the DIP segment, there is a incremental chance of posting higher margins. Understanding correct?
That's a fair understanding, but you have to see. You don't have to see on a month-on-month basis. You have to see on a year-on-year basis, because typically what you have is a raw material inventory of 2 to 3 months. So at some point in time you will have a higher price inventory, and then now the commodity prices have slowed down or come down. Then you will buy a new inventory which will be topped up by with a low price inventory. So the blend, you will be able to see the blend advantage over a year's time. So, but yes, the reduction in the commodity prices on the year basis is going to definitely help.
Sir, in the Saudi part, what portion we have got from the new city of Neom, sir? Any order booking we have done from there, and what is the pillar from that geography?
So we have booked a significant portion of orders coming out of Neom, and as you know that our Saudi mill is the largest and the best producing mill in the KSA, and like the same is the case in Saudi, and the same is the case in India. But and that is why we have the possibility of servicing requirements under Neom. There's a substantial requirement we are servicing at this point in time for that particular city.
Right, and lastly, sir, for the seamless segment, I said in the I think so for the do we have our presence in the seamless pipes and the premium thread business also?
So we are not in carbon steel seamless. We are in stainless steel seamless.
Seamless, yeah.
And we do not have any. We are not present into the thread segment. But having asked this question, I must say that this is a turnaround story, of the group. A company which has been a perpetually loss-making company, and this year, they are absolutely EBITDA and cash positive, and with a very extremely bright future. They are doing extremely well.
So you are talking about the Welspun Specialties.
That's correct. I'm talking about Welspun Specialties, please. I'm sure you have seen their financials.
Yeah. Sir, I just go through them. Sir, sir, lastly, on the share of profit and loss JV part, Percy, sir, if you could.
Mr. Kapoor,
Ma'am, if I could just complete with your permission.
Okay, sir. Please continue.
Thank you, ma'am. Yeah, this is the last. I'll join the queue. For the share of profit and loss from the joint venture and associates, sir, if you could give more color, how is this going to shape up, and what are the key components of the same? For the year, it is 76 crore profit, and for the quarter, it is 29 crore. Thank you.
Yeah. This share of profit is coming primarily from our Saudi entity. As you know, they have a robust order book, a very profitable order book, and I am sure this is bound to increase as they execute it.
Thank you, sir. and all the best, sir. Thank you.
Thank you very much, Saket.
Thank you. Ladies and gentlemen, a request to all the participants, kindly limit your questions to one per participant. Should you have a follow-up question, please rejoin the. Thank you. The next question is from the line of Vikas Singh from Phillip Capital. Please go ahead.
Thank you for the opportunity again. So just a small clarification I need, that 250 KT order book India you're saying, that is exclusive of that 140 KT of DI or is inclusive?
Exclusive. We are talking pipe, line pipes.
Yeah. And sir, secondly, on a previous participant's question, so is it that you have told us that the Syntex has closer to 700 crore cash and consolidation of that would have brought down our debt, or it's different basically? Because net working capital is still seems to be on a higher side, so that's what we wanted to understand.
Yeah. So Vikas, substantial of the cash which was on the Syntex BAPL balance sheet has been utilized for payment of the consideration, the settlement of the lenders as well. Some part of the cash has been retained on Syntex balance sheet also, because as the business grows, as they rebuild the brand, they will obviously need some of the cash for the business purposes, their expansion and growth and working capital financing also. But the short answer to your question is, majority of the cash has been utilized for settlement of the creditors.
Understood, sir. Thank you.
Thanks, Vikas.
Thank you. The next question is from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Congratulations, sir, on a strong set of numbers. I just wanted to understand, would it be fair to say that you have targeting a revenue of 15,000 crores for the entire year? It will be more skewed towards H2 of the year, considering the ramp-up that is being done by a company?
Vignesh, you are right. I think, this will be more skewed towards Q3 and Q4. You will be, because generally, if you see, in a project business, the Q1 is always a sort of a muted quarter, right? And then it starts building up in Q2, and then it reaches to its pinnacle around Q4. So that's the way it happens, and it is, across all the B2B businesses. We are not agnostic to that. So, but we are more than confident that we will hit this number.
But even if we say that the Q1, Q2 is muted, on a YOY, we would be seeing a strong set of execution, right?
Absolutely.
Right. So, second question from my side would be on this, the associate company of yours, which is in Saudi, which has received an order of, if I'm not wrong, 4,000 crores worth. What would be the execution timeline of that order?
So this order will start getting executed. Right now, they are already having some pending order books which they are going to execute till September. And this new order will come into execution from September, then will go to, let's say, May or June to the next year.
Okay. Sir, I'll get back in queue. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Vipul Mathur, MD and CEO of Welspun Corp Limited, for closing comments. Over to you, sir.
Thank you very much, gentlemen, all of you, for attending this call today. I think so. We will try to give you as much as information possible to quell any doubts or any questions you may have. But still, if you think that anything is still left unanswered and you really want to, you are more than welcome to circle back to us. And Salil and Gaurav and Mr. Percy will be more than happy to answer all of your questions. I just want to reiterate that, this company is absolutely on the cusp of growth. All the businesses, the line pipe businesses, which is our mainstay, the steel businesses, the Syntex business, and our WSSL businesses, all the businesses are poised to growth. I think so. Their performance of the last quarter is a complete testimony to that. The market pull is there, the demand is there, and I am sure all the operating parameters and processes are in place. The complete leadership team is in place. The complete bandwidth is available. So, and we are seeing also a tapering of the commodity cycle, which should help. All these factors put together, I think so, is putting the company into a good position, and you will continue to see superlative performance moving forward in the subsequent quarters. And we will come back to you on a quarter-on-quarter basis to give you an update around that. And we are very optimistic and confident to the guidance what we have given this time to the market. And we look forward for your continued support. Thank you very much for joining us today. Thanks.
Thank you very much, sir. On behalf of Emkay Global Financial Services, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you.